Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today I wanted to discuss a very important question, and that is, how does a trader turn an opinion about a stock into a specific options strategy? So how do we select from the dozens of strategies that are available to the trader and dovetail it with that trader's convictions about stocks and about markets? Today, we're going to be going through a three-step process for strategy selection. I think it's going to be an interesting discussion. Some of you are going to be familiar with this process. For others, it's going to be something brand new, but hope you'll all join me along for the entire journey. But before we get into any of that, let me first of all say hello to everyone who's chatting in. Great to see all the familiar names. I see a couple out there that look like they might be new here. So hello there, Olga and Eva, Bill, Lucky, Mighty Mouse, Kevin, Greg, John, Jerry, Jay Richardson, everybody else. Thanks for joining us week after week. We certainly do appreciate your attendance and your contributions to these discussions. But if you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the recording. That's a great way to watch these webcasts. But be aware that you're invited to join us in the live stream if you'd like to be here in the audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern. Now, I also want to let you all know that my very good friend Mike Fairborn's hanging out there in the chats. Mike's going to be keeping an eye on any questions that I can't address just during the natural flow of the presentation. So thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody to follow us on social media. Mike's already posted our X handles there in in the chat, but you can follow Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. And as of just a few months ago now, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion. How do we choose among the dozens of available option strategies, the one or the handful of strategies that might seem to be most closely fit a trader's convictions about markets and about stocks? So as we do this, of course, we need to bear in mind the risks associated with trading options. Just pay close attention as we go through these disclosures. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so here's what we're going to be doing today. Let's set an agenda. We have in front of us a great big important decision to make as a would-be options trader, and that is, how do we choose an option from among the dozens that are available or an option strategy? So I'm going to outline three big important questions that an options trader might attempt to address that can help them narrow that field of potential strategies down to just a handful that might seem to align with their outlook for the market. So what we'll do is we'll outline what those questions are. We'll attempt to address them within the context of current market conditions, and then we'll use the answer that's provided there to select a strategy and plan and place an example trade today. All right, so let's get right to it. Let's go outline as we set the S&P 500 as a backdrop for today's discussion. Let me outline three big questions that may help that trader narrow down the field of dozens of option strategy candidates. Number one, and this may be the biggest one, and that is, are we going to place a bullish trade, a bearish trade, or a neutral trade? If a trader has tremendous skill with option strategies, but they're constantly trying to apply bullish strategies during bearish market conditions, they may struggle. At other times, if we're trying to do bearish strategy when markets are consistently bullish, that might also lead to struggle. While, let's say, a less skilled trader who's just getting the right strategy at the right time, maybe the markets can help to smooth out a lot of their timing issues. That's the concept here. But I think that just about any trader might agree that using the appropriate directional bias at the right time can ultimately lead to the success or failure of that trade. Number two is going to be, are we going to be buying or selling to establish the position? What we don't want to do is a mistake here. I know that when we are stock traders, we think of buying as being bullish, and selling is just what we do to exit a position, or maybe no, to take a bearish trade. Yeah, so buying and selling here, it does not mean get in or get out. Instead, it's referring to, are we buying into an option strategy to start a new position, or are we selling into an option strategy to initiate a new position? And I'll tell you how a trader might answer that question for themselves. And then finally, our third big question is the trader pursuing a high probability of success or high reward potential from the strategy? Typically, there's a teeter-totter effect. As the probability of success goes up, the reward for being successful typically goes down with options. So I'll outline that today, but let's start with this big first initial question. And before I address it, why don't you chat in? Let me know. If you are planning a paper money trade for, let's go for the April expiration. So what we're doing is looking here to see, is this trader expecting more bullishness, more bearishness, or do we expect more the markets in general to go sideways? What do you think? Would your vote be for bullish, bearish, or neutral? There's not a right or wrong answer, since nobody has a perfect insight into what the markets haven't done yet. But let's have a look. How might a would-be options trader address this first question? Well, they might look at a major market index like the S&P 500. And as we look at the recent history of the S&P, over the last, we've now stretched it out to about 6 months, going all the way back here to September 15th. The S&P has traded above 6,600 and below 7,000. That's a pretty narrow range. There were just 2 days in the last 6 months where we closed outside of that range. And really, the S&P has only spent a few hours outside of that range in total over that 6-month time frame. So I think naturally, this might incline someone who thinks that this is likely to persist. Maybe they're leaning a little bit neutral. However, traders might also look, where are we within the context of that established neutral behavior over the last 6 months? Are we more toward the bottom and rising, or are we closer to the top and falling? Do we appear to be bouncing off support or ricocheting off of resistance up here? So let's say that our trader notes that over the last 5 weeks or so, the S&P has been working its way down toward that $6,600 level, or 6,600 point level, more accurately. We close to touched that. We didn't quite get down to 6,600. It was actually 6,636 on the low from yesterday, but then we're starting to see a rebound. Let's say, although I could certainly see an argument here for neutral, and of course, none of this is a guarantee that we're not just going to break on down and continue bearishly. That could certainly happen as well. But let's say that for our trader here, they think that on balance, it seems more likely that we are higher as we approach April 17th than lower at this point. All right. So let's just call that our decision. Are we right or wrong? We don't know. The markets will determine that. But what we've just done in making a decision is we've eliminated most of the available strategies from further consideration. That's a big deal. If we have, now at my last count, there were over 60 recognized option strategies. What we've done is we've just eliminated about 2/3 of those. Some of those are bearish. Those have been taken off the table. Some of those are neutral. Those we're taking off the table. And we're just going to be focusing today on the bullish position. So we're already narrowing it down significantly. Now the next question, we're going to cut the remaining list of candidates in half. And that is, are we going to buy some options to do a new bullish trade, or sell some options to do a new bullish trade? Because if we really strip it back down to basics, when a trader is bullish, they can buy calls, that's bullish, or they can sell puts, that's also bullish. One is buying, one is selling. So is it more of a buyer's market or more of a seller's market for options traders? And I'm not making the case that buying calls and selling puts are the only two choices that we have here, but variations on those themes are going to cover most of the remaining available strategies. So let's go look to see if it's more of a buyer's market or more of a seller's market. So the first symbol that we use to address directional bias for stocks is the S&P 500. Now we're going to go use the S&P 500 volatility index. And that is the VIX. This is going to maybe help that trader address whether it's more of a buyer's market or more of a seller's market. If you're not familiar with the VIX, it's just a gauge of how much volatility this is a simplification of what it is, but I think it's fairly accurate. It's a general charting of how much volatility options traders in general are expecting from the S&P 500 over the next 30 days. Sometimes there's a strong expectation of volatility. Sometimes traders are really not expecting much volatility at all. But the importance here for the would-be options trader is that when there is high expectations of volatility, when this volatility chart spikes, that also typically is accompanied by high premiums on lots of options. Because when volatility is high, option speculators might see that as potential for their trades that need the stock to move, or the stocks in general to move. Options hedgers might see this as risk, and that might drive them to demand more options to maybe hedge their portfolios using option strategies. In any case, spikes in volatility typically associated with higher premiums, and a seller's market is commonly described as a market where volatility has spiked and has started to fall. It's kind of like if you're trying to sell your house, you're trying to get the most value out of it. Well, if prices have come up and are starting to show a little bit of weakness, maybe that's the definition of a seller's market, right? Now, that's just an example of trying to optimize a different asset class. But in this case, when premiums are high and starting to fall, that might lend itself to a seller's market. When premiums are generally low, indicated by low volatility levels, some describe that as a buyer's market. Now, I don't want to make the case here that only sellers can participate in the markets when volatility is high and only buyers can participate in the markets when volatility is low, nor is it a guarantee of success or failure on a trade. But yeah, I think that there are those that might describe this as kind of a seller's market. So that's question number 2 addressed. So we're really starting to narrow the field here. Bullish strategy, big step forward in narrowing that field of strategy candidates. Among those bullish strategies, we're going to take out all of those that are buying strategies. Those are off the table. So now we're down to selling strategies. And we have a final decision to make because some of those bullish selling strategies are going to be high probability and others are going to be high reward. Now, I would forgive you if you have the impression, if you previously heard, that aren't selling strategies all inherently high probability with lower reward? Nope, that's not true. Matter of fact, today, here's what I'm going to do. I'm going to be pursuing, for today's example trade, higher reward potential. Now, how might the trader make that conclusion? We've looked at the stock market to gauge bullish or bearish or neutral. We've looked at the options market to gauge buying or selling. Now we're going to look at an individual stock to answer this last question. Pardon me. Just had to clear my throat there for a moment. So I've already pre-selected a stock, but I think it's fair to describe how I selected it. With options traders, not every options trader is looking for exactly the same thing from a stock, but some common themes that tend to run through a lot of the checklist items for options traders is the price per share. Price per share is correlated with the price on the options. More expensive stocks tend to have more expensive options and so on. They also come, if we're buying options or selling options, the rights and the obligations tend to be larger. We have to deal with just bigger numbers. So for better or for worse, the price of the stock might come into consideration. Liquidity tends to be a big deal. Illiquid stocks tend to have illiquid options, makes it harder to trade to get into, to get into and out of those efficiently. So lots of liquidity tends to be a point of emphasis for a number of options traders. And finally, what's happening on the chart? Well, if we're looking for a bullish strategy to enter into, maybe we want to see some indication of bullishness on a chart. So here's the stock that I've selected. It's Walmart, but it's a stock that's in the low single digits for price. That's not saying that's the best for everyone, but that's the case for Walmart today. It's one of the most liquid companies in the world. And for a technical trader, can we make an argument that there's some potential bullishness being expressed on the chart here? Now, a bear might look at this and say, isn't there a few lower highs right here? Maybe, bringing us back down to a longer term upward trend. So this can be our example stock for the day. But I'm going to hit the pause button on addressing this final question here for just a moment, because I just noticed that there has been a survey link that's been added to the chat for those that are here in the live stream audience. So if you're here, do me a favor, click on that survey link right now and then fill that survey out when the webcast is over. A couple of things you should know about that survey. Number one is that it's really short. 2 questions. That's it. There are 2 questions, and then there's a comments box and a suggestion box. But if you take the time to fill out that survey, I just promise you, I'll take the time to read it. It's never a wasted effort. All right, so thank you for doing that, Mike. Thanks for reposting that survey. Campsite saying, why not just buy a put option? Well, Campsite, in that case, that would be going precisely contrary. And it's not to say that other traders might have different convictions about current market conditions, but buying a put is, well, first of all, it's a buying strategy. And with high volatility levels, maybe we're just paying an extra high premium at the moment. At the same time, it's also a bearish strategy. So it's going counter to this bullish conviction that our hypothetical trader has here. But in any case, don't ever come away from one of my webcasts saying, Cameron said that this was the strategy to do today. Nope, this is an educational discussion. And you put 2 traders in a room, one might have very different convictions about the markets and the other looking at exactly the same charts. All right, Wiley, that's probably not going to happen. With my apologies, yeah. Wiley's saying, can we do a cruise with the coaches? Nope. We have enough on our hands as it is. Yep, that would be fun though. Anyway, let's look at what's going on with Walmart. And let's talk about how this chart might help the trader make their decision on this final important question. Well, Walmart seems to be running up and pulling back and running up and pulling back and running up and pulling back. It looks like we might be bouncing off an upward sloping trend line. So let's say that our trader here is looking back over recent history and they note, wow, here it went from $100 to $115 and beyond. That was about a $15 move in a relatively short period of time. Then we pulled back, and then it went from $110 to $120 with a little bit of rounding, obviously. So there's about a $10 move to the upside. And then it pulled back. It went from 115-ish up to 135-ish. That's close to a $20 move. So 15, 10, 20. Let's say that our trader not only thinks that this stock looks like it's bouncing off a couple of potential support areas, a horizontal area, but also a diagonal area, but maybe they're relatively aggressive in their expectations for what the stock might do next. So if we've just bounced a little bit above 120, let's call that 122, all right? Let's say that our trader thinks that, at a minimum, by April 17th, maybe their expectation is that we're likely to get up here to at least 130. Maybe we go back up to those previous highs. But they have a relatively optimistic outlook for the stock. Now, this may inform this final decision that they're making, because the balance that they might be trying to select here is, or the balance that they're trying to strike is, well, if my timing is good, maybe I could turn this into a comparatively large amount of money. But if I'm too aggressive, I might be right about their direction, but I was too optimistic, and I could still mess up this trade and turn what looked like a bullish move, if it wasn't big enough, it might actually still turn into a loss. That's a possibility depending on how this trade is structured. And you'll see that in just a moment. But we're trying to balance probability with reward. Now, there are some traders that just prefer from one trade to the next. They just like to have higher probability on each trade. That's fine. There are others, though, who maybe they're consistently pursuing higher reward. That can be a personality thing. But finally, there might be a third group of traders who look to the individual circumstances and say, well, sometimes I'm highly confident about what I think the stock is going to do, and therefore I might use those scenarios to pursue higher reward. And when I'm less confident, maybe I'll go more for probability. In this case, Brian says, and by the way, hi, Brian. Great to see former neighbor of mine. Anyway, any thoughts with Walmart's upcoming earnings in today's example? So that earnings, fortunately, should not play a role. This trade is going to be done by April 17th. The previous earnings was February 19th, so we shouldn't see another earnings until March, April, May. So that should be beyond the expiration of or the time frame of this trade. All right, but let's say that our trader here, who's planning to do a bullish selling strategy, also wants to set the trade up to optimize the reward potential of the trade. And I know that sometimes it gets stated that selling strategies are high probability. No, they're not. It all comes down to strike selection. So let's go build our trade. I'm going to go to the trade tab, and I'm going to be careful to construct this one to make sure that it's not only bullish, it's not only built around primarily selling, but it also has a higher reward than risk potential. So let's do this. Let's change this to a single, change our spread to where it says single. That shows us all the individual strikes. I've gone out here to 17th of April for Walmart, because that was the sort of stated time frame preference of this trade. And let's look at, how about we look at setting up a trade that is optimized if the stock can extend itself up there to $130. We're at 125.48. That'd be about a $4.50 move. What's that going to be about? That's going to be requiring about maybe a 4% move on the stock, something like that, 4.5. Going up $4.50 on $125 stock is just a little bit beyond 4%. Not an enormous price move on the stock, but let's see if we can turn that into at least a 100% reward potential on our high probability? No, just our selling strategy here. So here's going to be our example trade. We're going to do a bull put spread. So here's how that's built. If you're not familiar with bull puts, it involves selling a put and buying a put. The one that we're selling is going to be the higher premium put, so it's going to be primarily a selling strategy. But we were looking at the 130 level. That might be where the stock can get to. Obviously, I have to say might because we don't know what the future holds. But let's go to the 130 puts. And if I sell that, it looks like it might be somewhere between 675 and 705. Let's call it 690. Okay, so we're going to sell the 17th of April 130 put for, in the neighborhood of 690. We'll see if we can get this thing filled, what it actually fills for. But we might actually stop right there. If we did this trade, is that a bullish strategy? Yes, selling puts is bullish. Is it built around selling? Yeah, explicitly it's a selling strategy. Is it a higher reward than risk trade? No, it's not. When we sell and collect a credit, that credit represents the maximum theoretical gain of the trade. What's the maximum theoretical loss? Well, if we have an obligation for the next 38 days through the 17th of April, where someone has the right to sell shares to us for 130, and those shares are collapsing in value, there's a lot of risk potential to the downside, and it can certainly go way beyond 690. So let's turn this into a higher reward than risk trade. Now, I haven't run the numbers on this yet, so we're going to find out if this is going to work. But let's at the same time we sell the 17th of April 130 put, let's look at buying the 17th of April one. Let's do the 125 put. Let's run the numbers on that. How much would that cost us? Somewhere between 395 and 405. We'll call it or 415. We'll call it 405. So what does this put do for this trader? Well, the first put, we're collecting 690, but we're getting into a contract where someone has the right to sell shares to us for 130 bucks. And if that was all we did, we'd have no idea if we got stuck with those shares, how much we could sell them for ourselves. We just know that we'd have to pay $130 for those. This second put allows us to define how much we can sell the stock for if we need to. And in that case, it would be $125. So if we got put the shares at 130, we could sell those to someone else for 125. That's a $5 risk. And in exchange for taking that risk, we're collecting a net credit of close to $3, not quite that much. What is the net credit of this trade? Or in other words, the theoretical maximum gain of this trade? Well, it's 690 collected by selling the one put. 405 spent leaves us with a net credit of 285, if my math is correct. All right. So we're collecting a net credit of 285 to get into a trade where there's $5 of risk. So having put the 285 in our account, and we can apply that theoretically toward the $5 of risk, how much is left over as additional risk? What's the maximum theoretical loss? $5 per share minus the 285 collected leaves us with $2.15 of risk in this trade. All right, let's do some quick math here. Is the reward larger than the risk? Yep, this is a high reward strategy built around selling. It is also a bullish strategy. So we need to talk about how we can make 285, how we can lose 215. Let's see, Mary Burns says signal seems to be bearish, MACD. Okay, so you're looking at some other technical indicators, and Mary, that is likely, there's likely some validity to that. I don't know, I'd have to explore it. But I'm not going to go too far into the weeds of technical analysis in this discussion, just keeping the focus more on options. Now, if you have an interest in learning more about technical analysis, so this is not speaking to Mary, but to everybody, I do teach a webcast series, or deliver a webcast series on Fridays. It's called Advanced Charting Techniques. So do yourselves a favor. If this is your first time here in this webcast series, welcome. Make sure that you're subscribed to our Trader Talks channel on YouTube. Go down below the video stream right now. Click on the subscribe button. It only takes a second to do that. It doesn't cost anything to do it. But our YouTube channel called Trader Talks Schwab Coaching Webcasts is where you can join these live streams, but you can also find playlists for this webcast series and for almost all of the rest of our webcast series. So you can go to playlists here, and I have a webcast series on Fridays. It's called Advanced Charting Techniques. So I'm going to scroll down here, and just beyond the halfway points, there's Advanced Charting Techniques. I can click on View Full Playlists, and in this series, obviously, we just get deeper into charting. All right. All right, CB's asking about trade management. Let's try to squeeze that in here, CB. All right. But back to our thinkorswim platform, let's sort of outline this trade. I'm going to clean things up a little bit, if you'll forgive me. Let me just remove this drawing. Then we remove this drawing. And let's draw in two lines horizontally. So we have one line up here at 130. That sort of represents the put that we're selling. And we'll take that right out to the April 17th expiration. Then we're going to go to 125. Look, we're at 125 already. So it's going to be right down here. That's going to represent the put that we're buying. So there are our two puts. How do we make money? How do we make the most money with this trade? Well, our trader is looking for price to rise up above 130 before, or more specifically, at April 17th. So as long as we're above 130 on April 17th, that puts us in position for the optimum outcome on this trade, the maximum theoretical gain. Because here's what would happen. Let's say we're up here. Doesn't matter, 131, 133, 135, or higher, whatever. On April 17th, and actually any time before that, someone has the right to sell shares to us for $130 per share. If those shares are worth more than $130, do they have much motivation to say, Cameron, here, I'm gonna underprice myself and sell you the shares at 130? Nope. That contract, with few exceptions, would just expire worthless. And we keep the $690 that we were originally paid. Now, at the same time, yes, we had the right to sell shares at 125, but those shares are worth much more than 125. So this just expires worthless. Keep the 690. The 405 is, I don't want to say wasted. It served its purpose, but it's lost. But that would result in our net maximum gain realized $2.85. That's $285 per contract. That was fun. That's how we make that. But this stock still has some work to do. Not a huge amount of work. It still needs to go up about another 4%. But if it is able to do that, we got $2.85 on the table. What if it does the opposite? So what if instead of going up, it goes down, and we're down below 125? Doesn't matter where. Could be at 124, could be at 115, just below 125. Well, if it's down there, someone has the right to sell shares to us for 130. It's way more than the stock is worth, so they do it, with very rare exceptions. And we say, oh no, we own a stock now. We had to pay 130 for it, and it's worth less than that. What might we do here? Well, we can at least sell it for 125. That's what our other contract allows us to do. So we're stuck with the shares at 130. We wind up selling those at 125. That's a $5 loss. And our $2.85 credit that was set up and that we collected in the first place, it's a consolation prize, but it still leaves us with $2.15 of loss. So this is not what we want to have happen. I think you can see why. This is a bullish trade. Has a preference for the stock to go up rather than down. Louise says, if we let it expire when it's up, will we make the maximum gain? Is there a reason, or is there a reason that we wouldn't? So here's what happens at expiration. Is a good question. Let's say we're up here at above 130, all right? And the owner of the put that we sold decides to sell us shares at 130. So Louise, you might be asking, do we need to call up the broker and say, hey, make sure you sell those shares at 125? Nope. Through a process known as same-day substitution, that's automatically done. Basically, all in-the-money options, both of these would be considered in the money if the stock is down here below 115 or below 125, pardon me. Well, there's one other issue I need to address, but if we're down below 125, I'm going to be explicit about that. Both those contracts would be considered in the money, and all in the money options are automatically exercised at expiration unless there's explicit instructions left by the owner of the option, that would be us, to not do that. That's not very common. We literally have to leave what's called a do not exercise order with the broker to not do that. Yeah, so if the 130 is assigned and if the stock is also below 125, the 125 is exercised without taking any additional steps. Now, that's not what happens every time. There's a third thing that we need to discuss. We've already talked about what if the stock's above 130 at expiration? What if it's below 115 at expiration? Well, what if it doesn't do either one of those things? What if it's in the middle? What if we're at 127 and we hit expiration? Someone has the right to sell us for those shares for 130. Well, great. That's a better deal for them than anywhere else they can sell the shares. So they sell the shares to us for 130. And we're thinking, oh no, these shares are only worth 127. Maybe I'll just sell them for 125. No, we wouldn't want to do that. That would actually be underpricing those shares. So that contract just expires worthless. And what the net outcome of that is that we just wind up owning the shares. And then whatever happens after that happens. Maybe we sell covered calls. Maybe we just sell the stock on Monday. Maybe we see if the stock continues to rally or if it continues to fall. Marcus says, can we close the contract early? And what is the cost, if any? Excellent question, Marcus. The quick answer is yes, with an asterisk. All right. Just because we've gotten ourselves into some contracts for the 17th of April doesn't mean that we have to stick with this all the way until the 17th of April to choose to exit. Now, liquidity can play a role. Let's suppose that we've decided, you know what, I want to pull the plug on this trade. Maybe it's going well and I just want to capture some gains, or maybe it's doing poorly. I want to cut the losses as much as possible. Well, if the contract's illiquid, it can get kind of sticky to try to exit the trade. So as long as there's liquidity, and Walmart's one of the most liquid stocks in the world, and its options tend to be highly liquid compared to other options on other stocks, then the trader can choose when they might want to get out. But it's certainly possible before expiration that we might be making money, we might be losing money. But what I want to outline here is that if this trade works out, that 4% move on our stock has turned a $2.15 risk into a 285 reward. What kind of a return on risk is that? 285 divided by 215 is a 132% return on risk. So is this a higher reward trade? Certainly is. Yeah, if we're just, let's just say that we're drawing that line at higher reward than risk. It's not high probability because the stock still has some work to do. All right, so let's place the trade. And how about we place this trade with some plans for exit, either to manage our profits if they're working out, or to manage the loss. Now, already there's smaller risk potential than reward, so this one might require some patience. But let's go to the trade tab. Here's a quick way to place our entry order. We can change our spread from single to vertical. That pairs up all the options one with the next. And then we just go to the 125, 130 option and click on that bid price to create a sell order. And it looks like the credit's gone down a little bit. Why is that? Looks like we might not be able to get 285. It might be closer to like how about we say 260? Choosing 260 very deliberately, because in a $5 wide spread, if there's $2.60 of reward, that leaves $2.40 of risk. It's still a higher reward than risk trade. How about we say that we're going to demand at least a 260 credit out of this trade at this point? So that's to get us into the trade. And let's just do one contract, just as our example here. Now let's manage the exit. And to do that, we need to put in some exit orders. So down here where it says single order, we're not just going to put in an entry order. Let's put in a first triggers OCO. This allows us, the first triggers OCO order type allows us to put in 2 exit orders. So here's how we do that. Go up to the original entry, right click on it, and create an opposite order. And then just do that again. Right click, create an opposite order. So these are 2 buy orders to get us back out of this credit spread that we sold to get into. But the first one, this is going to be the fun one. This is to manage the reward potential of the trade. So what we're looking for here when we sell a credit, whether it's a single leg option or a vertical spread like we're doing here today, we're hoping that it goes down in value so we can buy out inexpensively. We got paid $260 theoretically to get into it. What if we want to optimize that potential to the downside? How about, let's say if we paid $260, I'm going to throw out a number here. I'm going to say our trader is willing to spend up to 52 cents to buy back to buy back out of this trade. Why 52 cents? Because it's 20% of 260. Here's how we put that in here. I'm going to put in 0.52. That's going to be our limit. I'm going to make that good till canceled. But basically, if we receive an original credit of 260, and then if we're able to buy out for just 52 cents, that would leave us with 208, which happens to be 80% of the original credit received. This is the trader's effort to try to optimize that reward potential. Now, in an effort to minimize the risk, let's do this. Well, if the value of the spread isn't going down. Instead, it's going up. It's getting more expensive to close this thing out. Maybe that's not so good. So what if I put in another exit order at 390? That's 50% more than we were paid to get into this spread. And I'm going to change that to a stop order. That means stop the bleeding. It's getting more expensive to get out of this trade than less expensive. That's not good for this trade. I'd rather just be done. All right. Now, what this does, though, is it doesn't allow as much wiggle room for the trade to try to get up there and work out as much as it's just introducing a higher probability that the trade just ends unprofitably. We have to be aware of that. Okay, so Wiley says there's a question there that was posed that he agrees with. Let's see what the question was. What you say? My question also. Let's see. Was it Lawrence's observation there? I'm not sure. Anyway. Oh, interesting. Paul says I like to close these spreads at 50% to 80% of premium profits. Yeah, preferences are definitely going to vary there. I'm just using 80 and 50 as examples, but there can certainly be different percentages that are used by different traders. But this is how we can put those percentages into practice. And so, you know, if you wanted, let's say that our trader instead was willing to spend 30%, you just have to run 30% of 260. If they wanted to stop out, maybe they're willing to risk 60 or 70%, you would just add 60 or 70% to 260, and that becomes the stop. In this case, we've added 50%, and we've used 20% as our maximum that we're willing to spend to close out with profits. All right, but let's click confirm and send. And Lawrence, my apologies. When you say maybe my 2 cents may not be worth it, I didn't really read your question in enough detail to know exactly what the question was. So it's not that I'm ignoring it, just in the interest of time, I'm just sort of moving on. But in any case, let's sell this vertical. We're going to try to get 260 for it, and we'll hope to close it out for 52 cents. Or we also have a stop in place at 390. Now, for each of these, there's a commission to get into the trade. There are commissions to get out of the trades. Let's send this order off. And we'll see how this goes. But guys, we've talked through what I think is an important process. Now, it's not exactly the process. Oh, by the way, we just sold that vertical. All right, great. Sold it for 270. We were willing to accept 260. We got 270 for it. In any case, the 3 steps that I provided today might be helpful to some. It's not the only list that some traders use in the selection of an option strategy, but I think that it can be a very helpful list in narrowing that field of strategy candidates. So everybody, hopefully that was a good discussion for you. This is what we do on our Tuesdays. We just sort of talk through the process of trading options. I try to go at a pace that everybody can follow. If you enjoy these webcasts, make sure that you put it in your calendar to join me each Tuesday. I also have other webcasts throughout the week, which brings me to a point. We have a lot of educational resources available to you from Schwab. So in order to avail yourselves of the full range of available educational resources, first of all, make sure that you're subscribed to our Trader Talks channel on YouTube. You can just go down below the video, click on the subscribe button right now. It doesn't cost anything, but the YouTube channel is where you can join live streams like this one that we're doing right now. You can also find playlists of previous episodes or previous webcasts that we've delivered. Just look through the playlist right there. Mike and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. You can find Mike and me on X. You can find and follow Mike there at Mike Fairborn CS. You can find and follow me at Cameron May CS. Here's my X profile. There's my handle. But I'm very active on X. You can see 6,500 posts to date. And if you reply to one of my posts, I try to reply right back to you. And that just allows for interaction when the camera's not on. Now, you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS will take you right to my profile. Give me a follow there. I also monitor and respond to comments on my LinkedIn. So everybody, thanks for giving me your time today. There was there not? Yeah, there was a survey. Thank you. Yes. If you would take the chance now to click on that survey link, fill that survey out, 2 questions, and then a comments box and a suggestion box. It's never a wasted effort. I definitely read through that survey data. I read through the comments, and it's always helpful. Bob, my apologies. We've kind of run out of time there, but it is possible to display orders on your screen. But everybody, I will look for you in a future webcast. Oh, and also, I'd be remiss to not say thanks for all the thumbs up. I can see 172 people watching. 68 have already clicked the like button. Thank you for doing that. That sounds like applause to your presenter. It also gives us a nice boost in the YouTube algorithm, helps more people find these videos. But thanks for giving me your time today, guys. Go enjoy the rest of our webcast for the rest of the day. I'll look for you in a future webcast. I'll also look for you on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.